Hello my fellow freedom builders and welcome back to the channel. Now I have promised to make a little overview of the world's economic situation as I see it, and here it is. It will be quite brief, but I can give you a quick conclusion now. How I see it, and of course there's a billion different variables here, but as I see it, we have a situation in the world right now where the economy in US is actually reasonably okay, whereas in many other countries and especially in Europe it looks a bit more bleak. So that is the core conclusion, but let me show you a bit of the numbers. Now first of all, the week we get into here, we have a bit of a slow start of the week. This is on the daily FX and I chose only to see high and medium importance here. So what we can see, we get some interest rate decision from Japan. Notice that they are at minus 0.1% in their official bank interest here. And even with a negative interest rate, they actually have some problem keeping the inflation from dropping. Then when we get to Wednesday, we have some PMI numbers from Germany and Europe. They will be interesting, not so much for the stocks. And what I'm saying here is not directly related to stocks on a day-to-day basis, but more as a way to see where's the world moving from an economical perspective. Now, what I will look forward to, of course, is when we get to Thursday, where we have the euro area coming out with their interest rate decision. Now the forecast is that they will keep their interest rate at 4.5%, but as I will conclude in this video, I think that ECB will start lowering their interest rates quite quickly, and I think that they will be quicker in lowering them than the US, but that is only a guess from my point of view. Then we will see some GDP numbers and some core PCE numbers quarter over quarter from United States. And when we get to Friday, we get the PCI overall year-over-year numbers here and month-over-month. So especially Thursday and Friday in the upcoming week with the not the inflation rate, but the interest rate from ECB and some GDP and inflation numbers from US will be very interesting. What we have seen in the last couple of months and quarter and so on is that we are actually seeing some fairly decent numbers coming out of US. One of the reasons for that, at least that is my assumption, is that the Biden administration have set forth on an infrastructure plan that cost about $1 trillion, and where just by now they have started up 40,000 different infrastructure projects. That is roads, bridges, hospitals, internet connections, all sort of stuff. But that is 40,000 projects that are creating jobs and a lot of money around in the economy and society. So United States have the advantage that they have the reserve currency status, so they can do this without really hitting the economy too hard. But of course they are using borrowed money to do it. All right, let's try and zoom out a bit and have a look at the global overview. And this is something called conference-dashboard.org. I'll put the link in the video text below. But as we can see here, when we hover over the different countries, we can see the real GDP growth. And as far as I can read this, the real GDP is actually the GDP and then the inflation rate is subtracted. That must be it as far as that is what you normally call a real GDP. But what we can see is that in 2023 we had 2.4% growth in United States, but when we go to Europe, we had a negative 0.1% in Germany, which is a recession. There are several countries in Europe right now in recession. This is 2023. We had France 0.8, we had Netherlands 0.1, Poland 0.4, and so on, Austria in the negative, Italy 0.7, Spain a bit up at 2.4, 2.2 in Portugal, and so on. So this is quite low numbers, and with the German economy actually dragging everything down. We don't have numbers from all countries, but we have, for instance, from India with 7.2%, China 5.2%, and Russia with 2.9%. You can debate how much you trust the numbers from both China and Russia, but then again, it's not always the numbers from United States equals out with some normal logic. So yeah, I think from Russia and China, these numbers are probably should be taken with a grain of salt. Now, going into 2024, where we are now, we can see that United States is expected at 0.9%, and that is again real GDP growth, so GDP minus inflation. And we can see that the Eurozone is still dragging along with some quite low numbers here. And when we look at another interesting thing here, I'm at Trading Economics here, and I will put the link as well here. Now, what I'm looking at here is not inflation directly. Normally, inflation is called CPI, Consumer Price Index. But when we look at the PPI, we are looking at producer price indexes here. And what that tells us is basically what is the inflation among the producers, the manufacturers. Because if the prices are going up among manufacturers and companies, then they have only one place to place that extra expense, that extra cost with the product, and that is among the consumers. So if the PPI is going up, we normally see a lag of 4 to 6 months, and then the consumer price, the CPI, starts to go up because the PPI is pressing the CPI upwards. Now, when the PPI is negative, it means that the inflation, the prices among the producers are getting lower. And that means that when the companies have seen that go on for a while, they start to say to themselves, okay, now we're actually getting lower costs, so we can start to compete on the cost and sell things a bit more cheaply out to the consumers. And that brings down the CPI, the Consumer Price Index. Now, when we look at Europe here, we have the previous and the last, so we can see what is the difference here. And we can see a lot of the larger European countries have negative PPI. We have Belgium here. Bulgaria. It is coming down, or coming up, I should say here, but still in the negative. Denmark went to minus 0.8, not to call that one of the larger economies, of course. Overall, Euro area and European Union is around minus 8 to minus 9% year over year. That is massive. And that means that there's still a lot of room for the CPI, the normal inflation, to be dragged down. You can see Italy is actually getting worse here, minus 12.6%. What else do we have? The Netherlands here. Norway at minus 25% here. That is extreme. Poland is getting deeper in the hole here. Spain at around 7.5. Turkey, of course, is quite extreme. And we can see that as well if we're looking just at the core inflation rate. Let's take the normal inflation rate here. For the Europe, we can see that Turkey is down here with 64% in inflation rate. That is quite massive. There are countries, though, that are worse. If we are looking at, let's just see if we can see Lebanon, Argentina, Venezuela, Syria, Turkey, Sudan, and so on. There are plenty of countries that are hit quite badly, but the inflation has come down quite massively. And a website I like to visit is the one called Trueflation. It's a private website from United States, and it is measuring the US inflation. I'm actually not sure if they have. Okay, they have UK inflation as well. Also coming down, was quite high and is now down at around 3%-ish here. But the US inflation, which is one of the ones that really is focused on in the world, is down at 1.85% now, and that is downloading prices live constantly, million of data points. They have a whole description here as to how they do it, but this just tells us that this is actually a leading number compared to the normal inflation rate coming out from the official numbers in the United States. So all of this tells us that the energy is about to go a bit out of the world's economy. US, well, they are not in a recession. Everyone expected a recession in 2023. It didn't come. So the question is, will it come in 2024? Well, a recession is 2 quarters in a row with negative GDP growth, and I'm not so certain that it will come, especially since it's an election year in United States, and I'm not sure Biden will let that happen. He will not let Trump get that extra advantage to say, oh yeah, Biden brought us into a recession. So he will do basically anything. And with his infrastructure plan, I am actually fairly certain that he can keep United States out of recession here in 2024. But that is just a guess. So let's see what happens. Now, if you want to dive a bit more, especially into the European countries, I have found a report here from ING saying the Eurozone quarterly, and in here they are actually giving a bit of an overview, and then they're going through the larger companies one by one. Germany, another year of stagnation and political turbulence. We have down here France, and so on and so forth. We have all the major economies, and I will link to that in the description of the video as well, so you can go in there and have a look at it. So, what is my take on the economy right now, and especially compared to the stock market, of course, because we are investors? Well, I do think that the interest rate will start to come down. If we have a quick look at the FOMC countdown, that is here. Sorry. We can see that the next interest rate meeting is on the 31st. It is in, let's see, 10 days and 2 hours here. And the market is pricing in basically 100% certainty for the interest rate to stay where it is now. I think that is reasonable to believe as well. However, when we go out to the 20th of March, which is the next meeting, we shared only a week back, there was a priced in an almost 77% probability of at least one rate hike here in March. That has gone down to 46% now, and more people actually believe now that we stay at the same level. And that is from the Fed. That is the US official interest rate. And that is because that we have seen some quite good numbers. The initial jobless claims were very good last week. The NFP numbers, last time we got them, were quite good, and so on and so forth. So if these numbers keep being actually fairly decent, then there is not really any reason for Fed to lower the interest rate, because that is a tool they will like to save until the economy is really strained in some sort, where when they really can see a recession getting closer, then they have a lot of powder they can start firing. So if the economy seems to be doing fairly well, there's not really any reason to lower the interest rate, and with the risk of overheating the economy. So when we go through the year here, let's say we go to December, remember we are at a 5.25% right now, and when we get to December, the market is pricing in 1 to 1.5% drop in the interest rate in the United States. If the numbers keep being good, if Biden keeps pumping the economy because he wants to be re-elected, of course, then it might be in the part where we actually are only seeing maybe 0.75% to 1%. Now, in Europe, I think we have a bit of another picture, because I think the economies, there are several economies in Europe that are a lot more in a lot more trouble than the US economy. So I think that since we are seeing this Germany dragging the economy down, we are seeing a lot of problems in the different countries in Europe. I think ECB will be lowering the interest rates at a higher speed than the Fed. This is, of course, just my guess, but there is, I think it's a reasonable assumption, so that if US is dropping the interest rate by 1% this year, I actually think ECB could be lowering the interest rate between 1.5–2%. I have seen analysts believing down to dropping it by 2.5%, but yeah, let's see what happens. But I think the ECB will be more aggressive with their rate cuts than the Fed. If you are into currency trading, if you are invested in companies that are a bit sensitive to currency prices, then be aware that if ECB are dropping their interest rates quicker than US, then that will probably mean that the euro will drop compared to the dollar, meaning that the euro dollar will drop. So that is something you can consider if you are in some currency sensitive companies. So this is my overlook of the overview and of the entire economy. Again, I'm not an economist. I'm just reading up on this daily and trying to figure out what do the major analysts think, and then trying to make my own conclusion here. And my conclusion is that the world's economy is not breaking down completely this year. There are a lot of problems. There in China, there's a problem. We have some major issues in the Middle East that could, especially if Yemen and the Houthi militia and so on, if they have some luck in stopping a lot of the marine shipping through the waters down there, we might see some supply issues right now. But overall, I don't see the world in such a dark place as many of the, if you look at YouTube, I know that catastrophic thumbnails, they really sell. So if you're just looking around on Facebook and YouTube, you quickly get the picture that the world is basically about to collapse. I don't think that. We are in a bit of a strange situation, and it's not a massive growth scenario, and especially not in Europe. But I actually think that we will get through 2024 at a reasonable pace, at least not with a complete worldwide depression or recession. Also, I think that the stock market this year will actually do fairly well, and that is due to the interest rate cuts that I believe will be coming, because a lot of investors are focusing on the interest rates. Of course, a lot of the rise in the stock market prices lately are due to the market believing that especially Fed will cut the rate by 6, 7, 8 times this year. If that is not happening, that could give bring some nervousness and volatility into the market. But overall, if I should just make a clean guess, I would guess that the market is quite significantly up when we get to New Year compared to where it was New Year here between 23 and 24. That is just a guess, and as I said, there are a million variables here, so anything can happen. Wars can come, they can go, inflation can be affected and so on. But in my large overview, that is what I expect of the economy right now. All right, I hope this made sense. If not, please feel free to put your questions in the comment section below. And I will put the links to all of the articles and different stuff here in the comment section as well, so you can read it and see it for yourself. That's all for now. Take care of yourself and your money out there, and I'll speak to you again shortly. Bye.